Can everybody hear me? I want to make sure everybody can hear me. If you can't hear me, please let me know.
Sounds good.
Let's go. That's what I love to hear. All right. So first things first, I'm going to start today a little different. So we're going to be looking at.
You're recording?
I'm definitely recording, 100%.
Okay, cool.
Absolutely. So we're going to start off with the agent session. So last night I sent a agent session setup, which essentially was with the pair EJ. And now this model, I personally like it because it's for people that can't make the New York session or the London session and you want to trade the Asian session. It would be definitely suitable for you. So I'll share the documentation at the end in the Telegram channel and then the Excel sheet. We'll look at that after this. So essentially the method is you're using a yen cross pair and you're looking at the previous session, which is the New York lunch session, and we're going to be looking for the 15-minute swing highs and swing lows. After that, we're just going to scale down to either the 5-minute, 3-minute, or 1-minute, and I'm primarily looking for one specific PD array, which is going to be the fair value gap. After that, we're either going to enter on the trade with a zero point 0.5 or 1% risk and use a stop loss of anywhere from 10 pips plus 5 pips, 15 pips grand total, and you're looking for 10 to 40 pips. So this is just the first example. So this is August 15th, 2022. It's a Monday. And you can see I'm using the time period. Here I'm using 10 a.m. to 8 p.m. But I'm going to tell you, you don't have to use 10 a.m. Start at 12. The reason why there's an overlap with London close. So there's 10 a.m. to 12 p.m. I'm just going to cut off the London close and just say 12 p.m. as my cutoff and the start for the New York lunch, excuse me. And then I'm going to find my 15-minute swing highs and swing lows prior to 8 p.m. Now, anything above those swing highs is going to be buy-side liquidity. Anything below those swing lows are going to be sell-side liquidity. I should have not marked off this 15-minute swing low because we can see it's already mitigated. So it just solely should have been this one right here before 8 p.m. After that, I'm waiting for price to start. Price goes into the Asian session and immediately runs down and takes out the sell-side liquidity, as you can see here. So once it does that on the 15-minute time frame, I'm scaling down to the lower time frame, and I'm looking for a lower time frame market structure shift. You can see price comes all the way down here, and you can see price comes up. So there's a fair value gap on a down and a fair value gap to the upside. So most people would look at this and say, this is a BPR, or a balanced price range. You can see here, there's a 1-minute fair value gap after sweeping that 15-minute equal lows. If you go lower, you get the entry after getting that fair value gap. You go long. I have a stop loss of originally 10 pips, but I added plus 5 to make it 15 pips just to include the spread. And then I'm aiming from anywhere from 10 to 40 pips. As you can see here on the results, price hits the fair value gap. It does fall through the fair value gap. As you can see, it does fall through it. But that was my entry, and this was my basket of risk. So I can tolerate that risk because I'm only risking 1%. It's not something that I'm going to have to panic about. I'm not risking 2% or 3%. That would make me either blow more of my account much faster. You see I'm risking really small and then looking for higher prices. You can see ultimately price takes out the sell side liquidity below the 15-minute swing lows and it rallies up. So that day was successful. That Asian session model was successful. So like if we go back to the start of it, it's taking out the 15-minute swing low. Then there's a footprint or a fingerprint. And that's the fingerprint I'm using to go long on. And you'll see time and time again, there is some repetitiveness and efficiency to it. So here on Tuesday, same thing. The next day, I'm marking off the 15-minute swing highs and the 15-minute swing lows. Step 2, I'm just waiting. Asian session runs up, takes out the buy-side liquidity above the 15-minute swing highs. As soon as that happens, it breaks one here, it breaks another one here. I scale down, and I'm looking for some fingerprint, and there it is, a 1-minute fair value gap. Someone said they can't hear something. Huh. Can everybody hear me? One person can, Aaron can hear, Kimberly can hear. Okay. I wonder why you can't hear. Try to unmute your, I should be unmuted. Is your volume up? Check to see if your volume's up on both of your devices, if you have headphones in or something. If you can't hear me, please. Okay. Yeah, it would have to be your connection, my brother. All right. It is being recorded, so if you miss anything, it's going to be on YouTube. All right. So we can see the 15-minute swing high is broken here. Fair value gap is formed right here after breaking the 15-minute swing highs. You can see that there. If I can zoom in so you guys can see that. That 15-minute swing high, one is broken, another one is broken. But when this one is broken, do you see any fair value gap after it's been broken? No. So I don't worry about it. Nothing happens. Price keeps going. Boom, we get a fair value gap down. So we get a SIBI, essentially, a sell side inefficiency, buy side imbalance. The algorithm is inefficient in selling and filling in buy side on the way down. That's why it's leaving that gap there in price. Let's make sure of this. All right, everybody's good. Thank you, Aaron. I really appreciate you trying to help him out. Fair value gap forms here. I'm going short in there. That's where I'm going short. Price hits that, short, 15 pip stop loss. And what happens? You see, wait for price to return to fair value gap for the short entry. Does not get the first one. See that? Does not hit the first one. There's even another one on the 3. Right here. Doesn't hit that one either. But then it finally gets one here. Fair value gap. Price taps into it and then it sells off, gaining more, ultimately, basically anywhere close to 50 pips from entry. Even though there's multiple fair value gaps on the way down here, that doesn't mean on the 5-minute, right? There could have been just solely one larger fair value gap that I'm avoiding because I'm looking at the 1-minute time frame. There could have been a 5-minute fair value gap here, and price has already traded into it slightly, and it's selling down. Same thing on the 3-minute. The 3-minute time frame would have had a fair value gap that might have created some type of speed to the downside, and you could have went short. But for the model, I'm specifically showing you the entry from a 1-minute perspective, and that was the fair value gap that would have gotten hit, and you get the entry short. And so that was a successful day. Another example. This is the last example, and I'm going to go to see some charts. So we got Wednesday, August 17th, 2022. Same thing. See, I should have marked off this swing low. Made a mistake. It should have just been this, because the next candle I know is most likely, if it forms above here, not below the low, I know it's going to be a swing low. So you can see the next candle opens, and it takes out buy side liquidity first. So it doesn't even break the swing low. Does not break this swing low here. It takes out the buy side first immediately. Look at where it's running. It's coming from Asian Open, 8 p.m., and it's running up into what? A premium. It's above the opening price for the session. The same ideology that I've been talking about, SOP and MOP, same thing applies to the session's opening price. And using the storyline of liquidity, takes out 15-minute swing high. I'm alerted now. I'm scaling down. Something here happened. Look at the wick. Look how fast price runs up there. Gets a reaction down. Scale down to the 1-minute time frame. Look at what we have here. See, it doesn't take out that swing low here. It's still intact. The engineering, the sell side liquidity. Look at how they run price up, run price down, run price up, run price down. Equal lows. Right? Then they run up. This is all going to get eaten later on. It may fail. This setup may not work because price could come right into the fair value gap, give a reaction, and then just flop over and consolidate inside the fair value gap and stall. And then it goes back up, and then you'll be a losing trade. But that's why you have a 15 pip stop loss. See here? That's the fair value gap. Hits it right there 1 time, 2 time, 3, 4, 5, and then it gets out of it. This is the 1 minute. So it's not like it's sitting there for a whole hour in the fair value gap. Because if you have price sitting in a fair value gap for a substantial amount of time, for a long time, and showing you no reaction to go down, odds are the setup is going to fail. You instantly know when you're getting into profit. And you know that because when you hit buy or sell, You can see yourself in profit more times than you are in drawdown. That's how you know odds are you got the trade idea right. If you're sitting in drawdown, and the longer time you sit in drawdown, I'm telling you, the trade most likely is going against you and it's going to aim for your stop. At that point, your stop loss is not protection. It's now a target. The market is now going to target your sell and buy above it. Price runs away. And where does price run down into? The 15-minute swing low, where they engineered the lows. It all starts from here, that 15-minute swing low. Immediately runs up. I don't do anything until the break. Because what are retail traders doing? They're trading at any moment notice. As soon as price starts running up, they're buying. Because they're just going with the flow. Because they think market structure is just, oh, it's bullish. Just because they see up candles doesn't mean the market is actually going to continue to give that up move. You see it goes up, and then what happens? Fair value gap. That's the fingerprint. Price hits it, 10 pip SL, plus 5 if you want to include spread. So you have a cushion of risk. And what happens? You bang out more than 20 pips. Close to almost 30. You take 10, you take 15, you take 20 pips. That's all in the Asian session. Some days you'll get extreme runners, like the first day. The first day, if you remember the first example, almost 60, 50 pips. Those are nice days. But not every day you're going to get large dynamic setups in the Asian session. So aim small. So let's jump right onto the example. So 12 p.m. to 8 p.m. is the dead zone. No trading's permitted. You should not be trading here. So if I just take off, this is what it will look like without the indicator. No trading should be happening here. Now why? You can see most of the times it's consolidation. Now you may say, oh no, I'm cherry picking, or this is just one specific example you're picking. This was Thursday. This was yesterday's range. Look at most of the highlighted blue areas, and even the green areas too. Most of them move sideways. Most of the times, that price action is moving sideways. That is not by coincidence. Tight consolidations. Yeah, give or take, there are some days where it does trend in one way. But the fact that I see its characteristics tend to move sideways, I'm avoiding that. You'll see this on all currency pairs, majority of the times. When it comes to foreign exchange, there's consolidation at 12 p.m. to 8 p.m. So when you come back here, I know that trading is permitted at 8 p.m. Now I'm allowed to trade. I'm not supposed to be trading anywhere in between this period here. I start trading here. Then I start trading. I stop trading here, then I start trading here. Now, if we were to break down what happened here, we'll follow the same model. So let's bring it back. Right here. We'll take this off. This is a high. We'll take off the Asian session so we don't see that. This is buy side liquidity above this high. There's a low down here. This is sell side liquidity down here. And then we also have sell side liquidity down here as well. When the market opens, I'm just waiting to see which side does the market want to take first. So as soon as the market opens, it runs up. It takes out this high, right? The Asian session high. It runs it out. So instantly, I'm scaling down to the 1 minute time frame. That's how I would play it out. I'm going straight to the 1 minute time frame. But this is GJ. This is going to be a good example because I was looking at it. I was like, this looks unfamiliar. It's not the example I sent in the channel. But I would look for a fair value gap here, and you can see it's right there. to the downside after breaking that high. I would wait for price to come into here, then go short. So I'll go here, go short, and look for 15 pip SO. And then I would look for either 15 pips itself for 1-to-1, or I would look for 30 pips for 2-to-1. It's close enough. And then I would wait to see if price comes back into that fair value gap. And we have another, and it looks like we don't get that entry. Keeps falling. There's another fair value gap there too. You wait for it to see if it gets into it. Here to here. And you wait. Because if this market is going to leave you, it's leaving fingerprints behind to probably allow you to get into the market. Let's speed it up a little bit. You got the first one. There you go. So if you want to take this one, you take it short. But where are you taking it short to? The simple swing low. That's all you're looking to take it to. We'll speed it up. Now, I have no idea whether or not it went down there or not, but this is just going off of the model because I was viewing in the example for the Telegram channel was AJ. But you can see it comes back up. But from this entry point, could you have grabbed 10 pips? Absolutely. And even more from that entry. Potentially, before it started turning back up and getting back to your entry point, right, you would have potentially grabbed 20 pips from that entry there. Because this was the target. Doesn't look like it got there because it continues to trend higher. But that's your target. I'm going to play it out to see what happens because I want to see what happens at the end myself. And that's the end of the Asian session there. But you can see the whole idea and concept. You miss the entry there, you get another one here, and we go short. And you're aiming for 10, 15, 20, 30 pips. Nothing major. Normally 15 pips. Take it and run with it. But let's look at the example I sent on AJ. It was much cleaner. I'm only using this on yen pairs. So we're looking at a 15-minute time frame here. And it was Thursday. So bring it there. Like I said, you're not trading in this zone. You can see how it starts to consolidate? Look at this. Even though it gives a leg up, but look at how it moves sideways, right? Back and forth. That's 12 p.m. and that's 8 p.m. So I'm looking for the highest high that's going to form in that session. We got that there. So that's going to be buy side liquidity. Then we're looking for either a swing low or equal lows. We can see one right here. That's sell side liquidity. Or a low with a large wick below it. That's sell side liquidity. That's one there. This one here, it's unmitigated right there. And there's even one all the way down here. Then we have our time period, 8 p.m. to 12 p.m. Now this is where I'm going to start trading again. I have no care in the world for what's going on in 10 a.m. I keep saying 10. 12 p.m. to 8 p.m. I don't care about what's going on there. Because I know I'm normally going to be faced with consolidation. I play price forward, and I'm waiting now to see, okay, high broken. Now I scale down to the 1 minute. I'm looking for a fair value gap that's going down. So I wait for price. I'm waiting. I don't see any. I'm waiting. Nothing. You see how it's just sitting on the high? Look at all these 1 minute candles sitting. Finally, they leave a footprint behind. They leave a fingerprint right behind. Finally, something exciting comes into the market. That's the fair value gap. Now I'm hunting the short. And where am I going to hunt the short to? The most closest level of sell side liquidity based off of the 15-minute time frame. Right there. That's what I'm aiming for now. After taking a high. In Confluence, where are we to opening price when we look at it? That's the opening price. That's 8 p.m. So if we know the concept of Sunday's opening price and midnight opening price, anything above 8 p.m. is a premium. Anything below it is a discount. So anything above is a high probability sell scenario. Where's this fair value gap for me? Above in a premium, not a discount. Like I said, they sell in a premium. The algorithm is only going to sell in a premium and after especially breaking a swing point. So you see price comes down with speed. Now I want to go short here. The short position is as soon as it hits the fair value gap, I'm going short. Because you don't know, I mean it's the 1 minute time frame, but let's say if it was on the 5 minute and it was a larger fair value gap, you don't know how deep price is going to run into that fair value gap. I gotta grab the door. I had to get the door for my pops. All right. So price comes down back into a premium, but the whole time it's in a premium, in a discount. It moves up into a premium, and it's now showing you it wants to tear away after breaking a swing high. This session's high. Everything in that session, the New York lunch session, the dead zone, you're not trading there. Price plays, price hits it. You're now in short with a stop loss of what? 15 pips. To be safe, you're going in with 15 pips. That's what I would recommend. And you're only risking 1%. You're not in here trying to make huge amounts of profits in one single trade. And then you're either aiming for 15 pips yourself. And that's 18. But let's say we're just hypothetically just going straight back down to the 15-minute swing low. You press play, and you watch price. You see the speed? Look at all the fair value gaps it's making. Speed. Look at how it trades into another one. Pause. Trades into this. Runs through it. It's okay. Not worried about that. But look how it trades into it. Here goes another one. Fair value gap. And this is all the way back down to sell side liquidity. Every time the market keeps rallying up, what are they doing? They're inducing buyers. Back up at 8 p.m. again. Back at the high. I gotta fast forward because it's taking too slow. And then you see price tear off lower and tear off lower. Keep watching until 8 p.m. Trades, boom, stop. So now you can see price ultimately from the entry gave you how many pips before the turnaround? 13. So you got 10, got really close to 15. Now let's go on to EJ. This will be the last one, and then we're going to move on to another concept. So you go to EJ, midnight, 8 p.m., and you got 12. Same thing's happening here. This is a 15-minute swing high. Bring this back so you guys can see this properly. Like I said, this is a dead zone. This is a dead zone right here. Give me 1 second, guys. Yo, can y'all chill? I'm recording live on YouTube. I don't need the whole world to hear what you guys are saying. Thank you. Jeez. I apologize. This is a dead zone. This is Asian session, so this is a live zone. Just to say that you're trading here now. You're permitted to trade. Right here. That's the high. This is a swing low. This is another swing low. This is another swing low. So these are all unmitigated lows. This is all sell side liquidity. We'll leave it dashed. It's not a big deal. That's the buy side liquidity there. Put it red. And then I play it forward. Just like the model is telling me to do. I'm just waiting for it. Breaks the high. Okay, thank you. Now what do? Scale down to the 1 minute time frame. I'm looking for that fair value gap once again. That's that 15-minute swing low. That's that 15-minute swing high. Here comes the fair value gap. Price hits it. See that there? Price comes right up into it. You're going short. To what point? You're going to the 15-minute swing low. That's what you're going to be targeting. You're going to have a stop loss of 15 pips. I'm not going to draw it, but you're going to have a stop loss of 15 and draw it all the way up just in case. Because people are going to be like, you got to do it. Got you. Price trades into it. And we're going short there. Let me hold. See, makes another fair value gap. Look at that. Fair value gap, fair value gap. Which one would I take? I would personally take the top one. Why am I taking the top one? Because of this. You gotta get rid of it. We'll hide this one. I would take this one up top because it's the one that's breaking the low instead of the bottom one. Instead of this one down here, it's not breaking any swing low. I'm not taking it, I'm taking this one. So if price were to come back into this, I can pyramid that and go short again there. Play it forward. It does come back to the original fair value gap again. Play it forward. And then it hits it. It hits the sell side liquidity here. Now what is going on at this point? It's now mitigating sell stops. Anybody that was buying and making profit on the way up has a protective stop loss below this low. It just ran that. Now, does that mean there's a buying opportunity here? Potentially. But does that mean that it has to now reverse and run back up? No, it doesn't have to do that. It could continue to sell off because this is still liquidity that it could want to still target before it's ready to run back up, before it's booked its order, its book, to say, okay, now we've grabbed enough liquidity to now run back up higher. Does not have to turn around here. What happens here? There is a footprint that happens again. Now let's say we're looking at the high that we came off of because we know this would be a 15-minute swing high up here. This would be a new buy side liquidity because it's coming from buy side down to sell side. Could it go back to buy side again? Yes, it can. What would we look for? We would look for a fingerprint. Play it forward. No, it actually drops lower. I thought it was done. It dropped lower. So you definitely bagged more than 15 pips. That's where I want to show you guys. So now here, took out another 15-minute swing low. But if you go on the 15 minutes, this is what it looks like. That low right here, 1, 2, 3. That's that 15-minute swing low right there. Look at how it takes it out. Go back on the 1 minute time frame. And what do you see happening here? Play it forward 1. Stop. Is this not a swing high here that it ran out? 1, 2, 3. Is that not a swing high that this fair value gap took out right there? Yes, it was. It's a simple fingerprint that you could be looking for. There it is. That's the shift that I'm looking for. I want this shift. I want to go long here. What happens now? I get in long. Stop loss of 15. And then I'm aiming for something up here. What am I aiming for? Most likely this. And where are we in price when this is about to happen? In a discount. You see how this blends together? We're in a discount. This is 8 p.m. This is 8 p.m. opening price. This is the start of the session. Anything below it, it's going to be discount. High probability buying. And after sweeping what? Sell side liquidity. We took this and we took this. Then we got this impulse up, shifting the market here. Press play. Price trades down into the fair value gap. And we hold. Agent session is not the fastest session, I'll tell you that. And you can see how you would get that profit. And you mark the high all the way over here. It's outside the agent session. But prior to 12 a.m., you've made profit. You're trying to bank your book, your profit for the day inside the session. As soon as you get out the session, odds are you don't want to be trading. And that's right here is midnight to 2 a.m. That's another dead zone. I'm not trading. And then that's all London session here. But look how close we get to that high. Look how close they engineer the highs. Look how close we got to the high. But it all started from what? The narrative of what I'm looking for. 15-minute swing low broken. Okay, do we get a fair value gap up now? We don't. The entire way. So I know it wasn't ready to buy. We don't get any fair value gap to the upside until we get to this low. Boom, we get to that low. Then the speed comes in right there. Speed through the swing high. Price trades down into it. And you book your profits. And I'm risking small. I'm not risking 3%, 5%, 10%. I'm not trying to show off, oh, I just made, a certain amount of pips and money in a short span of like 30 minutes. No, it's not the point. The point of view is to be a disciplined trader, risk properly, and to have longevity in trading. You're trying to have a long-term trading career, not a short-term trading career. And you're going through this cyclical cycle of blowing accounts and having poor risk management. Risk 1%, move on. And you tackle that. And you'll do that for day after day after day after day. Just like this. Look at the Excel sheet. You do the same thing every day. Anywhere for the key is NA, there's no answer, or basically no entry. But you'll see I have it set up and designed based off of that model. 10 pips, 20 pips, 30 pips, 40 pips. Any plus sign extra is 10. Because I didn't want to keep making a larger graph. On Monday, what did I gain off of the model? 10, 20, 30, 40, 50, 60. Tuesday, I got no entry. Here on Wednesday, you see Wednesday, I got 10, 20. I only got 20 pips for the day. For that session, the max amount I would have gotten from the entry following the model, I would have only got 20 pips. The next day, 20 pips. The next day, I fail. So the F stands for price hit stop loss. And I'm only risking what? 15 pips. So I would have lost 15 pips there. Same thing here. Look at the next day. I get 10, 20, 30 pips off of the entry. I'm scaling out. I'm taking my profits when I can. The next day I fail. I lose another 15 pips. But look at how the winners are outpacing the losers. I'm getting more than 15 pips most days. And I'm only risking 15 pips. Look at the next day. I get 10, 20. The next day I get another one as well. I get 10, 20. The next day I lose 15. I know this says F for all of them, but if I got the first F here, that means the trade failed. Right? That means I hit 15 pips. P, 10, 20, 30. And I didn't even start at the beginning of the month either. I started a little late in the month when I started tracking the model. And then I do the same thing for the next month as well. And there are going to be days. Look. I took 3 losers according to the model. 3 losers back to back. Look at that. 1, 2, 3. Each one is 15 pip loss. Look at each one. Look at all the Fs. Only one F means I failed the trade. 15 pips loss. But look at the moments where I pass. 10, 20, 30, 40. Each plus sign is another 10. 40, 50, 60, 70, 80. I made 80 pips in one day based off of the model. September 1st. Waiting from either, so you can see price went down. No, price was going up because I have a stop loss that's down. So it was obviously a buy that I was looking for. And price ran from the entry, 95.13. It ran up that many pips from the entry. The next day, I only get 20. The next day, I lose 15. 15, 15. No entry. I get no entry. So whatever the entry I was looking for, I don't get it because I have the entry and the stop loss here. I feel another 15 pips loss, another 15. But look here. I get 10, 20, 30, 40, 50, 60. Just based off of the model. Short-term gains. Each day I'm not looking. I'm only trying to bank at least 20. At least 15. In between 10 and 20, 15 pips, I'm good. Happy for the day. I'm not complaining about that. But people like to glamour everybody. Oh, he caught 100 pips. That's not exciting. Yeah, it's cool to see it. But are they consistently getting that? Probably not. Because you can see here, based off of my model, I'm not getting these big trades every so often. Once in a blue moon, I'm going to get 90 pips off the model. It's a very basic model. That's why I really like it. Doesn't take much for people to comprehend. And you'll see there's days where I get bangers. And you can see the days where I fail. I get winning streaks. Winner, 1, 2, 3, 4, 5. 5 winning streaks. Now, I know there's some people out there that will say, oh, you could do a challenge, like a road to like 100K quickly, risking a certain percentage. So like, let's say I risk 2% each trade in a row. Yeah, it looks sweet. It looks cool because I gain a lot of money quickly. But imagine it was 2% three times in a row each day. 2%, 2%, 2%. I lost 6% of my account in 3 days, in 3 trades. That's crazy. And it looks good on paper when you win all these percentages back to back. Oh, he gained 2% one day, 4%, 6%, 8%, and then 10%. That looks good. But when it comes to these days, when you get 6 losing trades in a row, you're going to be in a deficit. You're going to lose more than 50% of your account quickly. And then I did the same thing for October, but then I stopped because I started getting onto other models and comprehending and breaking things down for other people. But that's how I use the agent session model. If I can find it, it's in the front. That's how I find this agent session model. Buy side to sell side. And look at where they're buying. This is logic. They're buying at a cheaper price for the session based off of when they booked all the liquidity. They took the sell side, then they ran up. This is a nice workable model. You don't have to do too much. You're grabbing only 10, 15. And you're holding, and you have a trailing stop. And where are you going to trail your stop? You're going to trail your stop below swing lows. Because if they're running high for buy-side liquidity, they don't want to break the swing lows. But if they do happen to break a swing low on the way up, you get knocked out. It's the end of the train. You get off your train, and you're done. And you made what you've got as far as you can with the trade. That's the point of a trailing stop. Other than that, if you don't move your stop, and you want to hold it, you may gain 20, 80, 50, sometimes even 100 pips if you hold on to the next day. There are examples like that when you see a trade continue on for a couple of more pips into the next trading day. But that's not a guaranteed everyday thing. You don't want the whole cake. You just want a piece of the cake. You want to take a portion out every session. Take a little portion, 10 pips here, 20 pips here, 15 pips here. That's realistic. Not everybody's getting 100 pips every day. The average trader is losing their first initial deposit in a live account within 6 months. Look up the statistic. They're losing their first initial deposit in 6 months. That's a waste of investment, if you ask me. In 6 months, I'm going to lose all my money. Why would I invest? Right? Why would I trade Forex? Well, there's ways to go about it to enhance your profitability. Now let's move on to IPTA. So somebody asked me, how can I blend in high probability scalps with IPTA? So first things first, to lay the groundwork, we know that the markets primarily work off of liquidity and interest rates, right? Swing highs and swing lows are what control this market. That's it. That's all it is. Don't overthink it. On all the higher time frames, daily, weekly, monthly, and even the lower time frames, it's all swing highs and swing lows where the market is turning. Whenever there's a turning point and a new leg up or a new leg down, a swing high caused it or a swing low caused it. That is sound principle. It doesn't take a rocket scientist to see that's happening in the market. Anytime a swing low forms and then we see another leg, the origin is a swing low. Anytime you see a leg down, the origin of it is a swing high. That's always going to be the case. When I look at market structure, and we'll just look at this small example here. When I see a swing high broken, I need to see a higher swing low form. That is how the market is working in a 3-bar pattern, especially on the daily time frame. This is a swing high. See this swing high here? 1, 2, 3. Why is this a swing high? Because we're going to get into how it blends in with IPTA and how you can use it to catch swing trades on a higher time frame. 1, 2, 3. That's a swing high formation. If the market breaks this, right? Immediately to myself, I tell myself, okay, market structure, the momentum, it may be short term. It may not be long term because it could be short term. The momentum has now shifted bullish. This is a quick, cheap way to understand where momentum is, essentially. Price broke a swing high. Now, if a higher swing low forms, price action is more likely to make another leg higher and give you a couple days that breaks the previous daily highs consistently. That's how you find the trending environment. So what happens the next day? You see price go up, up. What is this? What is that formation there? 1, 2, 3. That's a swing low. It's higher than this one. That swing low is higher. That's telling me momentum is most likely still bullish because this, the break of the swing high, so we'll color code it because I don't want to confuse people. I feel like it's clear when you color code things for people, at least for myself. That's a higher swing low. And this is a lower swing low. And that's a swing high. Price breaks that alerts me, okay, momentum is bullish. I need to wait for a higher swing low to form. So this same formation, 1, 2, 3, I need to see this same formation higher. We get it here, 1, 2, 3. This third candle here, so I'm also showing you guys high probability scalps. This is the model. If you want to find high probability days where price is going to run through a previous daily high or run through a previous daily low, this is the model. If this third candle is broken, odds are we're going to keep trending higher. That's how I like to do it. Being safe and getting extra confirmations like this will tell me, okay, price will probably most likely keep running higher. Price breaks that. Once price breaks this high, see how it doesn't break the low? Someone said something in the chat. But okay, cool. You see how it breaks the high and not the low? I gotta hide this. There we go. That third candle. We're running back one more time. Price opens, runs down, and then runs the high. This high now becomes your high probability scalp. Whatever you're trying to do the next day, whether it be midnight opening price, whether it be in London session, New York session, you're trying to probably find a buy setup to get you above this high. That's what you're looking for. That's the high probability scalp high. This high, it's now a high odd that it's going to take out this buy side and not this sell side. That's what you're looking for. And you can see how it runs through that high. Does come back, but you do get the high probability run on that high. At some point in time, the price action was going to give a nice strong move up here. You can see it does pull back. But there are cases where it breaks the high and then it continues going higher. But that's just how you would get that high probability run on this buy side liquidity above this high. You knew it would most likely it was going to get here. Now, when it comes to IPTA, I'm doing the same thing. Inversely, if a swing low is broken, stop. So when a swing low is broken, I'm looking for a lower swing high to form. So I'm using previous data to comprehend what's going to happen in the future. This is the month of February, so this is my time to play. I have about a couple weeks to probably find some huge trades, whether it be 30 pips, 50 pips, 80 pips, something. I'm trying to get something out of this time period here each month. If I simply just look at the 20-day look back, just this, we don't have to look at every single one, just looking back 20 days, I find the highest high and lowest low. That's the lowest low here. That's the 20-day low. And then we find the highest high. That's here, 20-day high. So we can get rid of this now. The same idea that I just showed you, we're going to do it inversely on the way down now. Price starts, takes out the buy side liquidity. Okay, we may not still trust this. You know, if you're not that advanced, you may not want to go short here after breaking the high. You may not have gotten this opportunity, or you may have not seen this as a short opportunity. Other traders might have and caught this right there at the top of the top. Got the monthly high. They called it. Boom, they got in short. Price then has this swing low here that you would eye. And if price breaks that, you know momentum is probably most likely going to be bearish or shifting bearish. Price breaks it. And it breaks it with speed too, because we know the next candle creates the fair value gap. There it is. That's the fair value gap. Took out the 20-day high, the if the look back 20-day look back period here, looking back from February 1st, 20 days gets you January 3rd, 2023. And then we count forward 20 days, get you March 1st. This is the speed and this is the momentum shift. Now I need to see this same formation because this is a swing high. That's the turning point. It's turning the market around. And this is going, we most likely are going to justify this as a long-term high now, or a key high. A high that's now protected, that they don't want to run because they're shifting the market down. There's the shift here, swing low broken. This is the 20-day low, so we know there's sell-side liquidity below it. It took out the 20-day high, buy-side liquidity. If it's aiming down here for the month, and the draw for the month is down, and it's showing you signs it wants to keep going down, odds are you know it's going to keep trending that way. But in order to get in trend with the market, you need to wait for the lower swing high. Because the lower swing high is where the commercials are then reloading the boat to go short again. So they sold up here, and then they took profit down here. They took profit below the swing low. They sold already after breaking this high, and it's dropping. They take profit, and then they're going to retrace price up. Because algorithmically, we know we don't want this inefficiency in price. We know it's going to cover that. It's dropping too fast. It's going to cover this somehow. But it's most likely going to cover this zone in a swing high. That's another thing I've been noticing. When price hits a PD array, it's normally doing it in a swing low or swing high formation. We press play. Right there. 1, 2, 3. We got a swing high formation now. It's a lower swing high. That's what you would have to wait for. Now, many people may say, oh, but that's so many days. Yes, you got to be patient. Every day is not a trading day. You got to be patient. You want the grand sweep of the pips or the majority, the bulk of the range, and you want to be doing it efficiently and safe to yourself, you wait for the confirmation. Look at the swing high. It's a lower swing high. You're playing it safe. Now you know, okay, odds are it's going to keep going lower. That's that third candle low in that swing high formation. If this candle's low is broken, we'll play it out. It broke. I'm like, yes, that's a good sign. It broke that low. That means that this candle's low is the high probability scalp. I hope I'm not losing anybody here. It's the same thing I just showed earlier in the video. Swing low broken, 1, 2, 3, shift. Now it's a lower swing high forming, 1, 2, 3. They have now positioned themselves to go short again. They've been accumulating net shorts the whole time. They're going short here, they're going short here, they're going short here. And then it unfolds itself here. In these up close candles, they're most likely selling. They're not buying. Just because you see it's up close doesn't mean they were heavily buying. No, they probably were hedging in. They're selling. They're selling the whole time. And then finally, it shows itself here. And then you get a third candle, 1, 2, 3, broken. This candle is a high probability run on sell side liquidity. We press play forward. Look at how price runs that low. Runs both sides, but look at how the probability of it running that low was higher. We knew it was going to go down there because of all the signs. And if you want to take it another step further and look at it from a different perspective, if this market is trending down, all the up close candles are counter trend days. This is a counter trend day because we know the market is going down. Anytime it gives me an up close, I just know that's a new opportunity to go short. This is a new opportunity to go short. This is a new opportunity to go short. This is a new opportunity to go short. And then it finally drops. New opportunity to go short. Then it drops. This close is up. You can see it's an up close. I'm still going to go short the next day. Look at that. Drops. I'm going short the next day. Even though it did break the high, no, the momentum is still trying to reach down probably for this 20-day low. My higher time frame open float. My higher time frame draw on liquidity. This is essentially January's low. It's close to January's low. It's January 3rd right here. Because gold does not open on the 2nd. All the currency pairs like pound, dollar, they all opened up on the 2nd. Gold opened up on the 3rd. You can see the previous day is December 30th. The next day is January 3rd. Essentially getting back down to January's lows. And that's how I would use IPTA to finding my high probability scalps. And then a trending model. And you see how price continues to go down until we get to March. March, you can see they're now inducing traders back to the buy side. They're now inducing traders now to the buy side. This is March now. Look at how high we are back up now. Above what? Let's look at this again. We're above the opening price for March, the monthly candle. Look at what it did for February. This is the opening price for February. They got everybody to go long, and then they sold on everybody. Look how foolish people were. Unless they seen this. They got everybody to go long. Everybody thought gold was going to go high and dollar was going to go low. Dollar's getting weaker. Come on, guys. Dollar's going weaker. But we know seasonally, from January to February seasonally, the dollar is strong. And it showed itself, and it played out this year for 2023. It's in history already because it's already done. It's now prehistoric data. You can go back and use it as hindsight now. Takes out the high, runs low. Simple for the whole monthly candle. That's what you're observing here. So if you look at the monthly chart, look at that. That's what you're observing there. Right there. Boom. Runs the high and then drops on everybody. Because you can see that from the daily time frame. That's what they did for the entire month. And that monthly candle was down. Up, down. Now think about this. If the market structure is still bearish, if the trend is still bearish, what are they going to do? They're going to get retail traders on the wrong side again. If this month is going down, March, if March is going to be a down month, let me get this first. We go April 3rd. If March is going to be a down month, what are they most likely going to do to the public? They're going to trick everybody. This market is not here for you to win. They're going to trick everybody. They're going to tell everybody, yes, gold's going to go back up. And dollar's going to drop below March's opening price. To get everybody to think dollar's weak again and gold is strong again. And what do they do once again? They probably do this again. They probably do that again. And then they do inverse for what DXY is doing. They're trying to get everybody back into a premium, high odds sell scenario for themselves. They want to make the most profit. They're the ones controlling the price action. When I say they, I'm talking about the commercial speculators. We are the small speculators. When we buy and sell, it doesn't move the market. When they buy and sell, it moves. That's literally why the market even exists. Without the commercials, we wouldn't be trading Forex. We wouldn't be trading bonds. We wouldn't be trading gold. Because the market exists because of their sole presence existing. Without the commercials, there would be no candles here. We wouldn't be allowed to trade. There needs to be a liquidity pool first in order for these candles to even move up and down. There needs to be a buyer and a seller. There needs to be transactions at all times the market is open and closed. Open, open and closed. When the market is open, there needs to be transactions going on consistently. There's buyers and sellers all day until it comes to the weekend or it comes to a period where there's no trading going on. They get everybody to go long, and odds are they go short. And then what do you do again? You use IPTA. You look back from March again. You look back 20 days, 40 days, 60 days. And you look to see, does it run out the 20-day high? The 20-day high would be here. I could already tell because I've been doing this for a while. If you look back 20 days, the 20-day high would be February's high. Does gold run back above February's high? I don't think so. I think this is just going to be a short pull up to get traders to go short. Now, why do I say that? Because if you look at the weekly time frame, what are we trading into? Fair value gap here, and there's another fair value gap up here. So there is probably going to be mitigation on these inefficiencies in price. Price runs up into it and then sells off. It just ran into this one. Here to here. That's that right there. That's that first fair value gap. And then that's the larger one on top of it right there. Ran into this one. Could this be a counter trend weekly candle? Think about this. Because all things are fractal. Like I said, with that idea of midnight opening price, Sunday's opening price, the session's opening price, the monthly opening price, the daily opening, it's all fractal. Think about this. Look at how this market was trending up. This is a leg up. From starting into September 2022, even October, November, going all the way up into December. You can see now it's hindsight, it's trending up. But look at how the down close candles are just counter trend candles. Look at it. Counter trend candle here. Right there. We'll use an arrow. An arrow would be a better depiction. Counter trend candle. Counter trend candle. There was 2 weeks that were down. That's where the commercials are reloading their buys. They fooled everybody that gold was coming back down. It was just for them to buy again. You see that? Do you guys see that? I hope you guys are seeing that. And I hope that makes sense. That's just a counter trend candle. Because given hindsight, we see it's going up. That means in all these down close candles, they were just buying again, heavier. Increasing net shorts in these 2 days. In these 2 weeks, sorry. See how it's fractal? The same thing with the daily time frame. This whole week was down. Just to get retail traders back short. Just for them to take out their buy stops. Because if they're going to sell, they think it's going down. They have stop losses above the previous daily high. And they run the previous daily high, taking out the retail traders. Same thing on the way down. Let's look at a leg down. You see this whole leg down in price. It's hindsight, yes it is. It's a whole leg down. But look at all the counter trend candles. Look at all the weeks that are up. It's a trending environment, but they're fooling people on the wrong side. Look at how many times they pull price back up in this leg. Here. Get it here. Right? Look at how many times they do that. And normally, immediately after, what I like to say to myself, if it's trending down, I want to see heavy distribution the next candle. So the next week. Sometimes it doesn't happen. You see that. 2 weeks up, then a down one. 1 week up, then down. And then it's down for the next 4 or 5 weeks. You see that. 1, 2, 3, 4, 5. 5 weeks down. Same thing here. It's up, 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 up. And what happens after? Finally, you get the sell-off. But do you guys see the market structure that's going on here again? With the higher time frame swing highs and swing lows? What happens? What starts this leg down? What starts this leg down? That. Let's break this leg down. This is market structure. This is the most sole principle thing that I think everybody in trading any asset class should know. This is the most simplest way to look at market structure and finding momentum. The easiest way to find momentum. That's a swing low. Yes, you may be looking at this. Everybody say, "Oh, this is a rejection block." Thank you for letting me know that that's a rejection block. All the ICT, super, fans, like these guys are just, really methodical. They want to know every little PD array. I'm like, you don't need everything. But yes, okay, thank you for showing me the rejection. Oh, no, it actually started here. Thank you. I know. That's a rejection block. Thank you for pointing it out. I know that too. Swing low, broken. But this is for the people that don't know this. Swing low is going to be broken. It's the weekly chart. Right there. As soon as that happens, I'm telling myself, wow, this is the weekly chart. It's running a swing low. Is it now going to continue going shorter? I don't know. Maybe not. Right? Maybe not. But what do I need to wait for? A lower swing high. And where's that higher swing high? Up here. And you'd already see it starting too, because this is a higher swing high as well. Look at the swing high up here. And look at how it made a lower swing low. Lower swing high. Broke a swing low. What do we need to form? A lower swing high now. This is the weekly chart, guys. Same thing I showed on the daily. Same thing. Momentum is bearish. You can see it's dropping away. But eventually, the market makers are going to come in and do what? They're going to pull price back. It can't just drop in a straight line. There are going to be weeks where it's going to be up. It's not going to always keep dropping. We know that. That's inevitable. And we wait, and we wait, and we're just waiting for a swing high. This broke that high, so that's not a swing high. That high broke that high, so that's not a swing high. And we wait. There. 1, 2, 3. Is the swing high confirmed here? No. Now, why would I say the swing high is not confirmed here? Because the middle candle's low isn't broken. But if you were an advanced trader, you would say, okay, this is a lower swing high. Sooner or later, the low is going to get broken. So you want to jump on it early before any more confirmation. Price makes the swing high. If it takes out this, odds are it's going to keep dropping. But this is a lower swing high. 1, 2, 3. And look at how it keeps selling. They repositioned themselves to go long. Now they're turning the market down for another price leg lower. See the price legs? Do you see that? Look at the leg down, the pull back up, the leg down, and they're doing it after a swing high. So I know market structure is bearish, the momentum is bearish, and I've got my confirmation right there. And if you were to play it off a high probability, that's the third candle out of the swing high that's broken. That's the next candle that breaks it. There's a high probability chance price is going to run this low. And you can see the week runs up a little bit, and then it drops down fast, taking out the sell side liquidity. And that's where it brings us here. We break another swing low. The only reason we're getting a swing high is because we broke a swing low. I want you guys to know that. The only reason we're getting a higher or a lower swing high is because we either broke liquidity on one side of the market. Look at our swing low here. That's a swing low. 1, 2, 3. There's a swing low here as well. 1, 2, 3. These are being broken. So we know we need to prepare ourselves for a higher swing low to sooner or later show itself in the market. It's inevitable. We don't know exactly when it's going to happen, but we may have an idea where it might happen. Take this out. I'll take this out as well. These are swing lows that are broken, but we know now a swing high needs to form. Let's speed it up because it's the weekly chart. There goes that swing high. 1, 2, 3. Look at that. You see that? Look at the swing high that they just formed again. Pulling back price after breaking a swing low. It's a lower swing high. Market structure is still bearish. And look at the fingerprint. Look at the speed. Once again, look at the fingerprint that they're leaving behind. They can't hide that. If they could, they would. I'm telling you, if they could hide this from the public eye, they would want to hide it. But they can't. It's coded in the market. When they get into the market heavy, it's exposed instantly. It's like water falling over a glass. It instantly shows itself every time. It spills over. And look at where the swing high most likely forms. Inside the PD array. Somewhere in this area. Yes, it happened above it. It's not going to always be perfect. But we have a great idea of where the swing high may form. It most likely was going to form in this zone here. And there was going to be some type of short opportunity here. It happens outside of it. It's not always going to be perfect. And look at that. We run away. Another leg. Another leg. See how simple that was to see that? Another leg. But they're going to tell you all these other funny things to make you figure out market structure, swing highs, are not the primary drivers of market makers. Yes, it is. Swing lows are too. But they're going to tell you, oh, support and resistance. Oh, no, Deontay, I'm going to draw a little support zone. I'm going to draw a little resistance zone, and I'm going to find my trades that way. Doesn't make sense because my box that I draw for a supply zone or demand zone is going to look different from somebody else. But when someone looks at the chart and they're looking at Oanda, right? They're looking at the broker on TradingView and they see me draw this fair value gap. They can do the same thing because it's precise. It's measured. It's measured. It's not a random box that I randomly said, okay, this box now, like I draw it this small. You see people in their videos draw it this small. Oh, that's my resistance here. You didn't know that it was going to do that. And then price runs lower, making the leg. And it continues. The market structure continues until it does what? Gets to a certain point and shifts the market back up. Now, I guarantee you on the leg up, because we know going through November, December, gold runs up. And the same thing happens. Look at that. Look at the speed that comes into the market. Look at the speed that comes in on the opposite leg of this market. So if you were to look at it like this, up, down, this is the other side of the market. This is the bottom. This is the pit of it, and this is now going to be. This is where you're most likely going to try and aim for, probably, right? Coming down, and now you're going up. Take this off. What happens here? Market structure shares. Wow. On the weekly time frame, it told you. You're telling me price action did not tell you it was bullish. Because if you're telling me that price action didn't tell you that's bullish, then I think you need to reevaluate what you think bullish and bearish is and classifying what being a buyer and seller is. You need to define those things. What makes you hit buy? And what makes you think that the market is now turning? This is what makes me think the market is turning. This. Nothing too complicated to it. Yes, some people may sit here and say, okay, yes, you have a low here. This is a sell side raid. They accumulate orders down here. Yes, you could look at it that way too. So many ways to look at this market. They took out the sell side liquidity below this. They ran up and then they ran down and then they accumulated orders here. They're buying. Buying below what? A low. Look at that again. They're buying after breaking a low. They're not buying after breaking a high. They don't want to do that. Price then runs higher. Press play. I've got to readjust it. Wasn't finished forming. My bad. There it is, the fair value gap here. Trades into it. Trades back into the high itself too. The swing high trades back into it, what? An old high. An old weekly high trades right into. And price says what? See you later. Starts taking out buy side liquidity, making the new leg. After doing what? Making the higher swing low. This is the higher time frame perspective. This is how people know whether or not this market is going to trend strongly for the next 3, 4, 5 weeks. People are thinking short term. Break down the higher time frame and then break down the concepts onto a lower time frame. Then go into your weekly range, SOP, midnight opening price. But if you don't know where the weekly candle is going, you're just throwing a dart in the dark every single time. You're just randomly guessing if this week is going to be up or if this week is going to be down. But this is how I figure out whether or not I'm going to be a buyer or seller, and if the trend is bullish or bearish. This is how I'm defining it. Look at how it even breaks this low here. Where is it? This one. Real, you can't really see it. Breaks that low there. They buy right there. Boom. Yeah, they broke the low here, but it's the same idea here. Look, they're breaking a low. They broke this low and this low, and now they're buying below a low. Once again, that's the only way commercials are buying. They're getting into their huge positions under lows. Simple. They're getting into their huge sell positions above highs. That's it. That's the sole principle of them buying and selling. Buy cheap, buy low, sell high, sell in a premium, sell when it's expensive. That's what they're doing. They're buying it cheap, below a low. Below 2 weeks low. So they broke this low and this low. And then it runs higher, making what? A higher swing low. 1, 2, 3. Third candle's high is broken. Look at the high probability scalp model. Third candle here broken, right here, by this candle. That means this candle the next week is the high probability run. You need to figure out whether or not where you're going to buy to get the blast off to the high up here. That's what you're trying to do. You're trying to get to this high here. We know that it's a high probability run on the buy side liquidity, and it's a less probable run on the sell side liquidity. We're not thinking that. We're thinking that it's most likely going to run up, not down. So we're finding some buy scenario to get us to the target high. And then so ultimately, from this high probability scalp, it can still continue higher. This is why I said you can find a trending environment when you use this model. And look at how gold trends. It has to make a higher swing low in order to keep going higher. Right? If this market is still going up, it has to make higher swing low to go higher. Could this market still be looking to trend higher? Yeah, it can. Because what? These can be counter trend candles. Down week, down week, down week, down week, and going up. But because of this footprint here and this footprint here, that could tell me, okay, maybe it is bearish. Maybe it is changing trend. And then I check on the lower time frame to see whether or not if price action is supporting that. Actually, looking at this now makes you think that gold is bullish. You see how easy my mindset can change now? Thinking that gold may still be bullish. That these were just down counter trend candles. And dollar may be dropping down. And I need to check the dollar and see what's going on. So hopefully that makes sense. So we got SOP. Same thing. This is the current week that we were just going through. And we'll take off all of these as well. Sunday's opening price is the weekly open. And we're on the hourly chart looking at this as well. Anything below is a discount. It's high odd buying. I don't know why I got selling here. Buying. It's oversold when it drops down here. Now, if you were the market maker, where are you most likely looking to buy? In a discount, yes. And after breaking a previous daily low. If you were the market maker and you wanted to sell, you would do what? You would sell after breaking a previous daily high and in a premium. Let's check out Monday and Tuesday and see what happens. This is Monday's high. Here. That's the previous daily high. Here. There it is. Price breaks the previous daily high. Commercials run the high. Where are you in price? Above the weekly open. You're above the weekly open, which is a high odd sell scenario. Now you're probably most likely going to be looking for what? A sell scenario during one of the kill zones. You're looking for some type of market structure shift on the lower time frame that will tell you go short here on Tuesday. That's what you're looking for. Either in London or New York session. You may not get it in London. You may look for a short opportunity in London and you may get stopped out. But then let's say you're taking 3 trades per day. and you're risking only 0.5% each one. New York, you have an opportunity. London close, you have an opportunity. London, you have an opportunity. You play price out, and you can see it takes out a previous daily high and sells. And then what does it run to? Runs right below Monday's low, taking out the previous daily low. So this day takes out the high and low. So it's an outside day, right? It takes out the high and low. What then happens the next day? We'll watch what happens. Midnight opening price. Price does what? Takes out what? The low. The previous daily low. When price gets here, it's still in the discount as well. And this is happening all in London. It's dropping very fast in London. London is getting price quickly down to the previous daily low. What do we have now for buy side liquidity? The previous daily high. So there's many ways you can trade Forex. It's just different ways and perspectives you have to look at it. Previous daily high. Look at how price gets to the previous daily high. What happens here on Thursday? Takes out the previous daily high, takes out Wednesday's high, so it takes out 2 days prior to its highs. Say here. Takes out the high. What? Okay. Takes out this high here. And takes out this high here. And it's doing it where? In a premium again. It's above the opening price, SOP, and it's above midnight opening price. We play it forward. It gives a sell scenario set up. Selling right back down into discount. And what does this do? Takes out the previous daily low. Once again, in a discount. Does it mean it has to buy? Not necessarily. But the odds of the commercials doing it are more favorable. It is Friday. That's why I say I avoid trading Fridays. I'm only looking to trade Monday, Tuesday, Wednesday, and sometimes Thursday. Friday, I would definitely skip every time. That's just me personally. I'm going to skip Friday and try and relax as much as possible. Let's look at GU. It's a great example. Like I said before, if they're running a previous daily high, that's where they're selling. If they're running a previous daily low, that's where they're buying. They're buying cheap and they're selling high. Simple principle. You can't forget that. That's how they're buying. And that's how you should be buying. And that's how you should be selling. You want to do exactly like them. It may not be the exact entry point because we don't know how they're trading or the central bank traders are trading, right? We don't know how they're specifically trading and how their charts look like. But we know it has to be something similar to this idea. Just bring it back here. You can see all the ideologies blending together. Sunday's opening price, the weekly open, and midnight opening price for each day. Look at the confluences that are occurring. Look at Monday. Monday, let's say hypothetically Sunday was a daily candle. And we're not considering it a daily candle. It just fills in the rest of the range for Friday and fulfills that daily candle, if anything. If you add Sunday's range to Friday's range and you add it together, you get a full day. But let's say Sunday in itself was a day. It took out Sunday's low, drops below midnight's opening price, and takes out Sunday's low right here. What does it do? It buys below the low in a discount for midnight opening price and the weekly open. High odd. I got selling on the chart. Must have copy and paste it. High odd buying. Price runs up. Makes the low of the day where? Somewhere in London. Starts earlier, 1 a.m. I like to start my London session at 2 a.m. Some people keep the extra hour, 1 a.m. That's up to you. We can see the low of the day comes in by London or shortly after London, and then it runs all the way through. New York just runs higher. Then we get into Asian session, London close, price moves sideways. You see the dead zone? Look at the dead zone that I was talking about earlier in the video. That's 12 p.m. and that's essentially no. That's even 8 p.m. too. But look, it's a dollar cross pair, so we know it's not going to have high volume in Asian session either. So that's why we don't trade the dollar cross pairs. We only trade the yen cross pairs in Asian, like in the model I showed earlier in the video. That's 10 right here. That's 10 a.m. right here to 8 p.m. Look at how it's consolidating. I don't want that. So I know every day when I look at this chart, I know there are moments in time where the market is just dead. It's just dead. There's no point in me trying to trade this. Done. I could go do something else. I could go work out, read a book, exercise, hang out with family, do something else in the meantime. And then Asian session starts and I start trading again. But like I said, yen cross pairs only. Doesn't mean you can't find setups in the dollar cross pairs during Asian session, but it's less favorable. You're not gonna get that. So we'll take this off, and we'll take this off. This is Monday's high. This is the previous daily high. There's what? Above that. Buy side liquidity. You're above Sunday's opening price. And you know if you're going to sell in this territory, because as soon as price gets above here, in this territory, anything up here, it's high odds selling. That's what you're looking for. And anything that comes down below there is high odd buying. That's what you're looking. That's how I'm interpreting this chart. If I had to draw a line in the sand and cutting in half, every week I'm doing this. And it goes for every day. It's the same thing for the daily intraday trades. Price trades above midnight opening price, takes out the previous daily high. And then price starts running lower. What's still intact now? We got a previous daily high, previous daily low going into the next day. That's the low. That's sell side liquidity. So if they're going to keep looking to sell, they're going to most likely target the previous daily low. This is where they got in at their heaviest short. Because if this is going to be the high of the week, remember last week I said Monday, Tuesday, or Wednesday is most likely going to be the high of the week if this weekly candle is most likely going to go down. So if you know the weekly bias is going down, these 3 days, Monday, Tuesday, or Wednesday, are going to make the high of the week. You can see that it's going to potentially form here. Takes out previous daily low. You're still in what? A premium. They're not looking to buy. Odds are they're still looking to sell. And like I said before, they won't go against their sound logic. They're only going to sell after they break a high. Look at what they did on Monday. They sold after breaking a high. They're not going to sell after they break this low. I mean, they're not going to sell after breaking this low. They're either going to wait for price to take out some short-term high or take out the previous daily high, then go short again. And look at how it moves above midnight opening price again in a premium for the day. And it's overbought for a weekly candle above SOP. Play price forward. Price moves above midnight opening price and Sunday's opening price. Price continues to tear lower, taking out what? Previous daily low once again. Previous daily high is still intact. Buy side liquidity, open float. Buy side liquidity, open float. Sell side liquidity. Look at Monday's low, still chilling. Play it forward. Price gets back down into discount. They engineer it. They get really close to the low. Back down into a discount. And they do this all when they're doing what? Breaking a previous daily low. They break a previous daily low. They run it lower back into a discount, high probability buy again. And they run it back up. Right back into Friday. And Friday, we can see it continues going up. And like I said, I avoid Fridays because I don't want days like this. See how it's in the premium still? And it keeps going up? It's a counter trend day. That's what normally it's a counter candle to the weekly trend. So primarily, the high of the week is here. And this is the low of the week down here. That's the low of the week. High low. Thursday makes the low, Tuesday makes the high. Friday is going to close higher off of the low and away from the open. That's what you're viewing here on the weekly chart. See that? Opened here. It opened here. Ran all the way up here because we know the storyline. Because it opened here from Sunday. Ran all the way up on Tuesday. right? Then Tuesday it ran, and then from Tuesday, because think about this, imagine this, because it looks green now. At one point in time, this candle was then dark, right? It was a black candle down. Price ran up, green, up Tuesday. This is Tuesday's high. Then it comes back down, comes back to the open, turns black again. It's a down closed candle now. Makes Thursday's low down here, like I said. Friday, look at how it turns back around Friday, all the way back up. And that's where it closes. Go on the weekly candle, you go back on the hourly. And that's what you're seeing here. Right? The open, that's the opening price there. Price is closing away from its open. That was the open here. That's the close. Its close is not down here. Its close is away from its open. That's what you're seeing here. That's the open. That's the close Friday. Right? That's what you're seeing. And that's a great example. Time and time again, you'll see weeks like this. Not saying you're going to see it every week back to back to back to back to back, because the weekly template looks different. It doesn't follow this formation. Yes, some people may sit here and say, that's head and shoulders, Deontay. I know that one. And then the neckline. Right? But look at how it gets killed back up. Friday comes right back in. And it does it strategically below in a discount. I don't use retail logic. That's not what's going to work here. This pattern is not going to hold through consistently. It may show itself here and there, but I know consistency and long term, head and shoulders does not help me. It won't help me have a long-term trading career using just head and shoulders. I know that. And then price runs back up. Let's see gold. This one is very interesting. So if you take all the sessions, gold, the entire week from Sunday, we'll do this quickly. Right here, the opening price is 18. There we go. That's the opening price for gold. Look at how gold, for the entire weekly range, keeps running higher. It runs below the opening price here on Tuesday. And what does it do? It takes out Monday's low. Where's Monday? It takes out Monday, and let's say, hypothetically, Sunday was a low as well. Like a day as well. It takes out Sunday's low. Takes out the lows. The commercials are looking to buy. You have an AMD setup. Accumulation, manipulation, drop down, New York distribution. Look how price runs all the way back up. Accumulation, manipulation, distribution. Runs back up into a premium. And they hold it up into a premium. Right? Because we can see that it keeps going up. And then other people will tell me, hey, Deontay, it's above SOP, but it keeps rallying higher. Yeah. Because we know that there's going to be weeks where it's not going to give the high probability sell scenario. There has to be. Like I said prior to that, there's going to be weeks, if I can find it, there's going to be weeks, let's say like this down week here, I'll remove everything, this down week here, this down leg right here, this leg down, there's going to be weeks where it doesn't do that. It just keeps running above SOP. We see that. These are these weeks here, especially the larger candles that have an open larger away from its close. Has an open and closed, like the distance between it is larger. That's how you know it went below SOP real quick, and it kept pushing higher. Kept pushing higher. That's what you're seeing. Not that chart. That's what you're seeing here. Keeps pushing higher. Look at the daily candles. Up, 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 up. Now, is this speed? Now, many people will sit here and say, oh, that looks familiar, Deontay. Looks like something's happening here. Yeah. Because if the next daily candle opens right here, daily candle opens here, and there's speed in between, that means this is a shift in price. And we've seen this before. This is a shift in price. If the next candle opens and closes without filling in this gap, they're leaving a fair value gap in here. They're telling you that they're stepping into the marketplace, and gold may potentially be going higher. And what is happening once again? If a swing high is broken, we have a swing high here, we need to see a higher swing low form. That's the swing high. That's the swing low, 1, 2, 3. We need to see the same formation form higher. Could there be potentially a fair value gap that forms here, and then the swing low comes up, creates a swing low in here, and then it goes higher? Yes. That's how I'm predicting these moves. Because I know the pattern follows itself over and over and over again. It did it here on the way down. Right there. Same thing. It did it on the way down. It's just vice versa now. And then it made the swing high, the lower swing high, inside the PD array with the higher swing high. Right there. And then that made the lower swing low. Lower swing high. Sorry, always saying things backwards. Lower swing high here. That's the higher swing high. The market structure is bearish. And it keeps doing that. And now, what does this look like? It looks like that same thing I showed on the monthly chart. Look at that's the top of the market. That's the next leg up, right? It's the bottom of the market, probably, potentially. That's the bottom of it. And now they're going to turn price up for another leg higher. So many ways you could look at this marketplace. If you look at it like this too, because I know, look at this. Down, up. This was at one point in time a bottom, a turning point. You can see a bigger one. Look at this. Down, up. Right? You'll see these turning points. You'll see that there's definitely a way down and a way up. The whole time back up. Now, many people are going to not know this one because I feel like people don't dig into this one. You look, if the market's going to make a leg up, this is a little trick I like to use. And ICT does talk about this, but people overlook all the little things he says. Not studying enough. If this market is going to do this, down, up, right? Something like that. On the left side, if we were to cut this in half, let's say this is the perfect half point here, right? Cut this on half. On the left side of the leg down, of this market structure down, or the cycle down, all we have to do is look back at all the up close candles. And this is gonna be very interesting. All you have to do is look at all the up close candles, and price is going to return to each one of them. Let's say this is the first candle that we have here. So this would be the top of the part, top of the other cycle, or the other leg up on this side. This would be that leg on this side if we cut this in half, like an upside down V. These are all these candles here, all the opens. This will get hit eventually, right? If the market structure is now changing bullish, and we'll see by next Friday. We're going to talk about next Friday. Price is going to return to all these up close candles. It already got to these ones already, and it's above it. That's what's going to most likely happen. You're using the bearish order blocks, right? Because it's an up move and it's an up move, and then price runs away from it. So in theory, these are all bearish order blocks. They're all down close candles, all of them. All these are all down close candles. They're all bearish order block theory. If price is going to go back, they're going to what? Mitigate the bearish order blocks. And then what are they going to do? They're not going to respect it for a setup. Why is it most likely not going to respect it for a setup? Because if this price like high and low, what happens when you cut this range in half? You have the same idea. Premium versus discount. You're in a discount from this leg because this is a swing high and this is a swing low. You cut this range in half. That's equilibrium. You're at a discount. High odd buy scenario. That's a core foundation to this market. Premium and discount. It's always telling you, okay, odds are this is generally going to be a better area to buy. And it's showing you. It's showing you. No indicators needed. The range is showing you. Now they're looking to buy. And you can see, look at the speed. They're trying to get out. They're trying to get out of a discount because discount prices must not last long. The public eye must not get these cheap prices. They want us to buy up here. They want you to buy expensive. That's what they want you to do. They buy cheap. The retail is buying expensive. The commercials are buying cheap. See how there's a flip-flop? It's an inverse to it. The retail traders are always buying at a higher price. That doesn't make sense. That doesn't make sense. And there's nobody on YouTube besides ICT, of course, and Larry Williams talking about these core foundations. All these other channels, I mean, no disrespect to the channels, but most of them are not of substance. They're not of substance. Look at all the channels. Look at all the clickbait stuff, all the money they show in your face, all the Lamborghinis, the Rolls Royce, the bust down APs, the chains, the Rolexes. Clickbait. They make money off of monetization, not trading. That's why they have so many views. That's how many have. They have more subscribers than ICT himself. Look at it, because that stuff captures people's eyes. It's a psychological warfare. They know desperate people are going to most likely tune into people that look like money. We know money doesn't look like anything. Money looks like nothing. Price now they're gonna buy price cheap, and then retail traders are gonna buy up here. And what are they gonna do? They're gonna offset it. They're gonna offset it. They're gonna sell here while everybody in retail is buying expensive again, and they get everybody holding the bag. Let's take an example of that. Great example of that is Bitcoin. Had an update on it. I want to bring it back to the first one. If you follow me on TradingView, you saw this, and everybody was like, Bitcoin is not going to go down. And I'm like, it looks bearish. And this is all thanks to ICT, the ATM bearish model. I think I've gone too far. That's ETH. I know I posted the Bitcoin one earlier than that. Oh, there it is. So I posted it late, but I posted the ETH one earlier. This is the ICT ATM model. So if you literally go on YouTube, type in ICT ATM model, it show you the model. I don't know what ATM stands for. I know I had someone ask me, what does it stand for? I don't know if it's an acronym. I have no idea what it stands for. He just calls it the ATM method. You have a short-term high, right, that's ran through, and there's a short-term low. If price gets back down to that short-term low, odds are market has shifted bearish. You can see that too here. How? There's a fair value gap. Look at the footprint. Time and time again, look at the footprint. Fair value gap breaks the swing low. They are now going short when price gets back into this zone. Yes, it's not perfect. You can see it gets above higher. It even gets back into this higher fair value gap here. Gets into there, right? But this is the high that the initial stop loss is going to be here. This is Bitcoin. And I don't trade Bitcoin seriously, but I just using it for studying models. What happens? Price is now going to... What? Why do we have the drawing tool? Come on, TradingView. What happens here? Price is going to return to all the lows. All the short-term dips and then the rally, that's the sell side liquidity. Look at the swing lows here, 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 here. And that's where they're shifting the market to now get back here. You break this range in half. If you cut this range in half with a fib, high to low, you know that up here is premium. And what is happening? Retail traders are buying at a premium. They're buying at a premium. Everyone thought Bitcoin was going to make a new leg higher. Buy Bitcoin, buy Bitcoin, buy Bitcoin. And what happens? It sells. Takes out sell side liquidity. And you have buyer remorse kick in. Every time, all these short rallies, there's retail traders buying. I guarantee you. Guarantee you. Every couple minutes, every couple hours, you're like, yes, new leg up. They're posting on TradingView. They're posting on whatever Telegram channel they're in. They're telling their friends, Bitcoin's going higher. I told you so. But they've already lost back here. Trust. Every time they saw this rally up, they've lost because their stop loss kept getting hit. They kept buying. They're optimistic that it's going to keep buying, but it's not optimistic. It's foolishness. And if you play it forward, look at how it drops. Look at how it's still dropping, all from this entry here. And where is it returning to? Sell side liquidity. Below those dip down right here. Sell side liquidity gets here. Sell side liquidity, and that's where I think we currently might pull a and then consolidate again, right? So they probably think, retail traders are going to do what? They're going to wait for another leg up. Come on, it's common sense. Happens over and over again. They're going to wait for another leg up. Everyone's going to go buy. And what are they going to do? Dump Bitcoin again. No one's buying risk assets if the Federal Reserve and the central banks around the world are increasing interest rates. Doesn't make sense. Look it up. Why would you buy a risk asset while the Feds are increasing interest rates? When you want to buy currency, what do you want to buy? Paper fiat money. Because the yields are increasing. If the central banks are increasing its yields, that means currency is going to increase. And let's take a look at that. Because some people may say, what are you talking about, Deontay? We'll take a look at it. We'll do it like this, actually. This will be the last. After this, I'm gonna get into the Q&A. If anybody has any questions or anything that they want me to go over, I'll definitely be down to go. What is going on here? Oh, there we go. It was just lagging. I know I have this on another template, but I want to show you guys this. This is the yields. It's the 5-year yield. 5-year. The yields. So when the rates are going up, this is going up. This is not the bonds. This is the bond yields. The yields. The flow of interest is going up. The Federal Reserve keeps increasing the interest rates. They kept saying that they were going to lower the interest rates and eventually stop, but inflation has become out of control, so they keep raising the interest rates. That means yields are going to keep going higher. See, this market structure is just trending up. The bond yields keep going up, 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 up. Just since the Fed said they were going to keep raising rates. This is the 5-year. I'll zoom in too so you guys can see this. What's happening here? Shift again, right? Swing high. Price comes down into the fair value gap. That's the swing high. That's your fair value gap up. Market structure shift. It's still telling me that it's going bullish. It's a continuation. It's going up with speed. That's the 5-year. Let's look at the 10-year. You have one here. Right? Price comes down. Yes, we ran through it. Happens. It's not retail logic, support and resistance. It's going to cut through things sometimes. It's going to happen. But we can see it, sound logic, fair value gap, speed up. Third year, no speed up besides this one here. Prior. More recently. Look at the bodies of the candle. Where they're respecting it. Don't look at the wicks. Look at the bodies. Look at where it's holding in. Here, here, here. So there's some type of respect to this area. It's not that I'm picking a random box. I'm picking a methodical point. This high to this low. I know that this is an area, quote unquote, that would act as support, the fair value gap. Now when we look at dollar, I'll clear this. Small. It's small. It's very small. It is indeed. But what is that? Oops. Fair value gap. They're all moving in the same direction. Look at the bond yields and look at dollar index. Ever since February, it's going up because the Feds keep increasing interest rates. Now, if they keep increasing interest rates and they are the world reserve currency, the global currency, the dollar, the way it's systematically structured, happens to be the world currency. I didn't make the rule. The Feds did, or whoever else did. If we look at the inverse correlated pairs, what have they been doing as well? They've been going down. As the bond yields keep increasing, they've been going down. Look at gold. It's been going down. What else do we have? Do we have AU? It's been going down. EU, it's been going down. So I'm looking at the bond market yields to show me whether or not dollar is getting strength. And because I'm looking at the bond market yields, it's still telling me that it's still bullish. There's no shift to the downside yet. I still think dollar is going to keep going higher and foreign currencies are going to keep going lower. Which is why if dollar is going up and central bank traders are more on the interest of yields, they want higher yields, they want higher returns, they're going to those currencies. That's why Japanese yen is getting smoked. Look at what Japanese yen is doing. Let's go like this. Here. Oh, not even this. We want to go to this. Look at the rates. Look at Japan. Negative. Nobody's putting their money into yen. Nobody wants negative rates on their money. No central bank trader wants negative rates. No bank wants negative rates on their money. People are going to what? Positive rates. Yes, you may be looking at other countries like Chile, South Korea, Brazil, Great Britain, Canada, China, Denmark, Europe, Hungary, India, Indonesia, Israel. Yeah, they have positive ones, right? But what is the world reserve currency? Feds, United States. Everybody wants the dollar. Regardless of what these rates are, yeah, Chile may have a higher rate, but I don't think Chile's economic growth or GDP is better than the United States right now, currently. No way. Not possible. Right now, everyone's putting their money into dollar. Simple. That's why Bitcoin is dropping. That's why no one's getting into Bitcoin. That's why ETH is dropping as well. So you look at ETH. This is the last one. I'm going to show you ETH, and then I'm going to get to the questions. Hopefully that answered a few questions today and opened some eyes. Where's ETH? Right here. That's ETH. The same model. Price breaks a high, quick, then runs quickly back down. Look at the speed. Again, same thing on Bitcoin. Same thing's happening on ETH because it's correlated. Look at the speed right here. That's where they're selling back into that zone. Yes, it runs above it, and then it gets back into this zone. You may not always get it precisely right. Runs it beyond, gets into this fair value gap instead. But based off of ICT, you look at the YouTube channel, go to innercircletrader.com on YouTube, and type in ATM method, and it's right there. And these lows are most likely going to get targeted. You can see how price keeps coming down, reaching for the low. Look at how price comes here and hits that low, taking out sell side liquidity. And it keeps running lower. I'm not sure where it's at now because I feel like I should have did Bitcoin over ETH. I think Bitcoin's more favorable than ETH. But all in all, that's what I have to say for Forensic Forex on Friday. Is there any questions that you guys have? Anything that you guys would like to go over? You can unmute yourself if you want to. Just be respectful and take turns. And if not, hopefully you guys found this insightful. So I'm just going to check the chat. Or if you want to unmute yourself, go ahead. I'm down to talk with you guys. Oh, what time is it? It's 9:48. Okay. Just wait. Let's see if anybody says anything. You Swissy. Still looks bullish. You see that? Looks bullish to me. There's that speed there. Price comes up, takes out a high, comes down, takes out a low, is running up higher. UCAD, same thing. Speed in the market. U.S. oil, not touching U.S. oil with the war going on. Not touching U.S. oil. It's been consolidating for a while. Hasn't broken out of this range. Everybody, don't focus on U.S. oil. It's not exciting. Not yet, at least. You want to see some type of swing high or swing low broken first, then to make your point. But right now, you can see the swing low was broken here. Got a lower swing high. 1, 2, 1, 2, 3. That's the lower swing high here for U.S. oil. And you can see how we're consolidating. We're inside this candle's range. We've been inside this candle's range, high to low, for U.S. oil. We've been in this range for a while, so we're consolidating. So we're not making new ground or making any lows. But since these candles are inside this range, and you can see it's getting even tighter too. It's getting tighter and tighter. Look at how this candle is inside this range too. And right now, this candle is still inside this range. So it looks like they're most likely probably getting ready to do something with U.S. oil. It's going to keep getting tighter until they can't hold price there anymore. They accumulate all the orders, and then they shoot it either up or down. That's up for you to decide. I would favor higher because of this bullish order block. We've been sitting in it for a while, so I want to see probably it run higher. It would be a monthly setup and price run up to like 130, collapse the world. I hope that doesn't happen, but like collapse the world. But hopefully you guys found this insightful. I'm going to end it here. Peace. No problem. Just before anybody says anything, I don't want to end it on them. That'd be rude. All right. Yeah. Cool. Yeah, I'll be able to get this on YouTube shortly. Enjoy the weekend, guys. Peace. And then we'll end.